Venture capital has long been an industry driven by trust, relationships, and long-term investment horizons, but in today's environment, limited partners are demanding more transparency and accountability than ever before. Gone are the days when LPs would simply write a check and wait years for an exit. With increasing institutional capital flowing into venture funds, investors now expect regular, detailed reporting, measurable performance metrics, and a clear strategy for capital deployment and risk management. For general partners, maintaining strong LP relationships isn't just about raising money, it's about providing continuous visibility into fund performance, deal flow, portfolio health, and long-term strategy. Transparency isn't just a compliance obligation, it's a competitive advantage for VCs who want to secure long-term commitments from sophisticated investors. In today's venture capital landscape, transparency is no longer optional. It's a critical factor in securing and maintaining LP commitments. Limited partners, particularly institutional investors like pension funds, university endowments, and sovereign wealth funds, are becoming far more rigorous in their oversight. Gone are the days when a broad portfolio update was enough. LPs now expect in-depth insights into fund performance, capital allocation strategies, and risk management practices before they commit capital. At the same time, increased regulatory and ESG reporting requirements are pushing funds to disclose more than ever before. ESG-conscious LPs are demanding visibility into how funds align with sustainability and governance goals. With regulations like the EU SFDR in Europe and the SEC's tightening oversight in the US, VCs must now provide more structured disclosures on investment rationale, risk factors, and performance benchmarks. The competitive fundraising environment further reinforces the importance of strong LP relations. With more funds in the market, top LPs have greater choice and will naturally favor funds that prioritize structured reporting, clear communication, and data-driven decision-making. Funds that operate with minimal disclosures risk falling behind, while those that embrace transparency will secure stronger LP relationships and more consistent capital commitments. Ultimately, VC firms that recognize the evolving expectations of LPs will have a significant advantage. The future belongs to funds that treat transparency not as a regulatory burden, but as a core pillar of their investor relationships. Maintaining strong relationships with LPs requires more than just delivering returns. It demands a structured and transparent approach to reporting. LPs, especially institutional investors, expect regular updates that provide a clear picture of fund performance, capital deployment, and portfolio company progress. To meet these expectations, VCs must establish a regular and structured reporting cadence. Quarterly and annual reports should include fund-level performance metrics such as IRR, DPI, TVPI, RVPI, and MOIC, alongside details on capital deployment and available dry powder. Portfolio company updates should highlight valuation changes, strategic progress, and any material risks. In certain cases, particularly for first-time fund managers or during volatile market conditions, LPs may request more frequent updates, sometimes on a monthly basis. Beyond the timing of reports, standardized performance metrics are crucial for ensuring comparability across funds. LPs rely on clear, data-driven reporting with key benchmarks including IRR for annualized returns, TVPI to measure fund growth, DPI to track capital returned, RVPI to assess unrealized portfolio value, and MOIC to capture the overall multiple of invested capital. Consistently tracking these metrics allows LPs to evaluate performance effectively and understand how their capital is being deployed. Equally important is portfolio company transparency. LPs want insight into how individual investments are progressing, particularly in late-stage companies or high-profile deals. This includes financial performance indicators like revenue growth, user traction, and burn rate, as well as strategic risks and potential challenges. A clear timeline for exits and expected return multiples can help align expectations and reinforce trust. Ultimately, LPs don't just back funds, they back teams that communicate openly, manage capital effectively, and provide a well-structured view of fund progress. Venture firms that embrace this level of transparency will build stronger, long-term partnerships and increase their ability to secure follow-on commitments. Transparency is the foundation of a strong LP relationship, yet many venture firms make critical missteps in their reporting practices. These mistakes can create uncertainty, damage credibility, and ultimately undermine a fund's ability to secure follow-on commitments. One of the most significant red flags for LPs is inconsistent or vague reporting. When updates are sporadic, lack depth, or fail to provide a full picture of fund performance, investors may begin to question whether risks are being properly managed. If a VC firm selectively shares only positive highlights while omitting underperforming investments, LPs may suspect that challenges are being hidden rather than addressed. Over time, this erodes confidence and raises concerns about the fund's transparency. Another common issue is overly optimistic valuations. LPs expect a realistic, data-driven approach to assessing portfolio companies, not just aggressive projections aimed at maintaining momentum. Inflating valuations may provide short-term reassurance, but it leads to credibility issues when inevitable markdowns occur. Trust is built on honest assessments, and LPs value funds that can present both successes and struggles with clarity. Beyond financial metrics, failing to address key risks and market shifts can create further misalignment. LPs don't just want to hear about wins, they need a comprehensive understanding of how external factors, competitive dynamics, or macroeconomic conditions could impact the portfolio. The strongest VC firms proactively acknowledge downside scenarios and articulate their strategy for navigating challenges. Ultimately, transparency isn't just a best practice, it's an expectation. The best performing funds don't shy away from difficult conversations, they embrace them. By maintaining open, candid communication, VCs ensure that LPs remain engaged, informed, and aligned with the long-term vision of the fund. As venture capital evolves, so do the expectations of limited partners. The days of static quarterly reports are fading, giving way to real-time fund performance dashboards. Some VC firms are now adopting investor portals and automated reporting platforms, allowing LPs to track fund performance 24/7. Tools like Carta, Allocations, and AngelList are streamlining the process, reducing friction in communication, and ensuring that LPs have instant access to key fund metrics whenever they need them. Beyond automation, AI is transforming LP reporting. Predictive analytics can now provide deeper insights into portfolio performance, helping LPs anticipate market trends and risks with greater precision. AI-powered tracking also reduces human errors, making financial reporting more accurate and frequent. This shift towards automation means less time spent on administrative tasks and more focus on strategic decision-making. At the same time, ESG-linked LP reporting is becoming a priority. Institutional investors are increasingly demanding transparency around sustainability, governance, and diversity metrics. In the future, LP reports may need to include detailed carbon footprint assessments for portfolio companies, diversity breakdowns across leadership teams, and ethical risk evaluations, particularly in sectors like AI, fintech, and deep tech. VC firms that proactively embrace these changes, leveraging AI, automation, and ESG accountability, will stand out. Transparency is no longer just a preference for LPs, it's becoming an industry standard. The funds that adapt early will not only attract more capital, but also build deeper, more trusted relationships with their investors. The future of venture capital belongs to firms that prioritize transparency, accountability, and data-driven reporting. As expectations from limited partners continue to evolve, the most successful venture capital firms will be those that consistently deliver clarity and trust. The best firms will provide structured, quarterly reports that include clear and comprehensive fund performance metrics. These updates will go beyond surface-level summaries to offer meaningful insights into how the fund is progressing. They will also share realistic, data-backed portfolio updates rather than relying on overly optimistic projections. Providing a grounded view of company performance helps build long-term credibility. Leading firms will adopt real-time reporting platforms and use artificial intelligence to track fund performance more effectively. These tools will allow limited partners to monitor progress with greater accuracy and speed. In addition, they will integrate environmental, social, and governance metrics into their reporting practices to align with the growing priorities of institutional investors. Most importantly, they will communicate risks openly and maintain trust, even during challenging market conditions. In venture capital, the firms that earn and maintain the confidence of limited partners are not those that succeed once, but those that secure lasting relationships and long term backing across multiple fund cycles.